Good afternoon. I'd like to welcome you to the Sheriff's Office Retirement Plan Board meeting on Thursday, January 28th, 2020 at 1 o'clock in the afternoon. We are located in the Chesapeake Building on Baldridge Street in Leonardtown, Maryland. However, in accordance with the Public Health Advisory on public gathering sizes at this time, the St. Mary's County Sheriff's Office Retirement Board of Trustee meetings are accessible by viewing St. Mary's County Government TV 95 and on the St. Mary's County YouTube channel. For those without access to cable television or internet, a listen-only line is available by calling 301-579-7236, access code 963443. Members of the press are permitted to attend. For additional information, please contact Karen Gates at karen.gates@stmarysmd.com. Thank you very much. So with that introduction, I will call the meeting to order. And we'll have a roll call. Myself, Dr. Rebecca Bridget, Jeanette Cudmore, and John Walters are physically present in the room. Catherine Pratzen, our plan administrator, and Karen Gates, our plan coordinator, are present as well. On WebEx, we have Sergeant Moses and Sergeant Safford. So with that, we'll entertain a motion from 2A for approval of January 28th, 2021 meeting agenda. That's today's agenda.
So moved.
Second.
We have a motion and a second. Any discussion? All those in favor to approve today's agenda?
Aye.
Aye.
Aye. Aye.
Any opposed? Motion carries. Thank you very much. 2B is approval of the November 19th, 2020 meeting minutes. We take a minute to review, and then we'll entertain a motion to approve.
I'll move to approve.
We have a motion to approve the minutes of November 19th. Do we have a second?
I'll second.
We have a motion and a second. Is there any discussion? All those in favor?
Aye.
Aye.
Any opposed?
Aye. Aye.
Motion carries. Thank you very much. 3 is new business, and we have 3A. We have Patrick Wing from Marquette Associates with us today. Thank you for joining us, and we'll turn the floor over to you.
All right, great. Well, thank you, everyone, and thank you, Dr. Bridget. It's great to meet you, some of you again, and a few of you in person and over the phone. But just recognizing the fact that not everybody was a part of the RFP and procurement process, thought it'd be helpful to just take a quick 5-10 minutes, give you an overview, background on myself, on Marquette, and talk a little bit about our investment philosophy and process. I think it'll provide some good context for when we get into later in the meeting and some of the recommendations and proposed board actions that we have for you all to consider this afternoon. So with that said, we'll start in the intro part of our discussion. That book, if you flip to page 2, you'll see my background there at the top. I am a managing partner, owner with the firm. Been with Marquette for about 7 years now. Have 17 years of investment experience, all with institutional consulting firms. Previous 10 years with a firm called Cambridge Associates, a larger institutional consulting firm. I was located in the Arlington office. With Marquette, I'm a consultant working out of the Westchester, Pennsylvania office, about 3 hours from here, right above the PA Delaware state line off of 95, so just a quick shoot down. With the firm, I focus as a consultant on public funds. Public funds are a very important part of our business as a firm itself, and specifically our office, which I'll talk more about shortly. So if you flip ahead to page 3, just a quick background on Marquette itself. You can see at a high level bullets on the left there, we're about 35 years old now. We have a smattering of offices. You can see in the second bullet point, we're headquartered in Chicago. Our Philadelphia office there is Westchester. We label it Philadelphia because unless you're from the greater Philadelphia area, you probably aren't familiar with Westchester, but we're about 30 minutes from the city. Underneath that, you see our assets under advisement, and then specifically in those sub-bullet points as it relates to public funds. So if you do the quick math there, the average public fund size is $1 billion. So we have a few bigger funds that we work with that kind of skews the average. But the median itself, below that, it's about $150 million. We really think that's our sweet spot or our core competency, if you will. And that median and average is really where we deal with in the Westchester office specifically, and I'll talk more about public funds because it's a great deal more important to our office than the firm as a whole. And then finally, I'll mention you see 100% employee-owned and growing. That's very important these days. There's been a lot of consolidation in our industry as far as firms merging and being acquired. We think it's important. We have 23 owners, all active full-time employees with the firm. And at the end of the day, what that means is since we're independent and employee-owned, that it increases the probability in 10, 15, 20 years that we're still going to be Marquette. And as being an owner in 10, 15, 20 years, if I'm fortunate enough to work with the county for that long, that I will be the lead consultant for the county. So that stability, we feel, is quite important. On page 4, focusing a little bit more on our office, we serve about 50 public funds out of our office, 50 institutional clients. About 40 of them are public funds, and about half of those 40 are counties in the Pennsylvania, Delaware, and Mid-Atlantic space. And you can see towards the right of that list at the bottom, those ones bolded up are in Maryland. So we've had a lot of success over the past 2 years, really gaining, building upon, and strengthening relationships in the area. And that's really been through participation. You can see at the top there through MD, GFOA, MACO, and things like that. We've been able to build our presence in the area. It's very important to us. So moving forward, we'll be continue to be focused on that. Again, strengthening, building upon, and creating new relationships. On page 5, just a quick look at the team itself. Obviously, you've met me now in person, but there's many others behind the scenes supporting me in the relationship. So 2 other consultants working out of our Westchester office. To the right of me there, Lee Martin. I've worked with Lee for more than 7 years now as a consultant on a number of relationships. And to the right of Lee, Lauren Salucci, who's now actually a senior vice president with the firm, also working out of our Westchester office. So over time, I suspect you will meet Lee and Lauren before too long, but amid the pandemic, we have a strict one-person attendance policy at meetings at this time for obvious reasons. So below them, to the left, you see Nat and Greg. They are the heads of research, Nat focusing on manager search, Greg focusing on asset allocation. So a lot of the recommendations from a manager perspective, from an asset allocation perspective, are being overseen by Greg and Nat and their team, working alongside myself to determine what to put forth in front of the board, trustees, and staff for consideration around those decisions. On page 6, just to flesh out the research team in a little bit more detail, you see again Greg and Nat at the top there. They are directors of research, but beneath them, they oversee about 20+ individuals that are full-time research analysts in their respective asset classes, which are bolded up beneath their names. They are charged with investment manager due diligence, so doing due diligence on existing and new ideas for client portfolios year in and year out, and then also charged with putting together asset class research for our clients. As we'll see on that next page, if we flip there, that's a big focus of our firm, is putting out client-focused research and education. So not just things that are sort of the narrative of the day or the theme of the day, but what's practical, what's relevant, what would our trustees want to read in between meetings? And that's an important part because our time together as trustees and as consultant is very precious. It's few, just given the amount of the responsibility and the importance of the decisions that we have before ourselves. So we make a big point in putting out this research, on a regular basis. So you as trustees and all our clients as appropriate or as desired, can take a look at these things to stay abreast of what's going on in markets, what's going on in the economy, to continue to fulfill your fiduciary responsibilities in between meetings. So we like to say there's something for everyone. So whether you like to, yes, sir.
Interrupt you for a second. How are those papers delivered?
We can sign you up to be on a distribution list, and I'm happy to sign up anybody as appropriate, and they will start to be delivered pretty much immediately.
What I can do is I can provide you with the board's emails.
That'd be
the
great.
Board member emails.
That'd be all I need. Yes.
And then if somebody chooses not to receive it or doesn't want, can they opt out?
We can turn it off and on like a light switch.
Okay, great.
And is there a regularity to the issuance?
Yes, so if you look at the asset class education, sort of the first part, those are somewhat more irregular as far as position papers, webinars, those are more of, depending on market conditions, we'll put them out. But then on the bottom, there's much more structure. So chart of the week, self-explanatory, weekly chart of the week, quick read, about 2 pages about what's going on in markets and again, why it's important. Monthly market environment, again, somewhat explanatory. On a monthly basis, we put out a market environment about the key themes across the economy and asset classes. Perspectives, we usually put out once a month, or somewhat of a longer paper, maybe 7 or 8 pages. Again, what's topical, what's going on in markets. And then quarterly market briefing webinars, again, self-explanatory. But again, there's papers, charts and presentations, or videos. So we like to say there's something for everyone. We even recently launched a YouTube channel. Unclear how many subscribers we have so far, but I think the uptake is slowly increasing, but we really just want to put things out because people like to consume content differently. So to the extent you'd like to receive it, we can get you signed up, and to the extent that you no longer want to receive it, happy to turn you off. But it is a service that we can provide for those interested.
Thank you.
Okay, you're welcome. So to wrap up on the next page, I think this will be important context for later in the meeting when we get into some of the overview recommendations and analysis. So we take a 3-point investment approach, and you see the bolded up words there. And I'll start with risk. So from a risk perspective, as you all well know, I mean, we could ask 10 different people what risk means and get 10 different answers, and all of them could be right. Risk means different things to different people, and sometimes various risks are more important to different people. So we do take a broader look at risk. So the things that we're looking at are volatility, quite naturally, but particularly downside risk. Because as a public fund, for obvious reasons, things are cyclical, or pro-cyclical, if you will. So if markets are tending to do bad, particularly equities, that's usually at a time when the economy is doing bad. Maybe tax revenues are coming in a little light, but then contributions may be ticking up slightly if you're not meeting your assumed rate of return. So there's these other factors that we take into consideration around risk. So obviously you've hired us to focus on the liabilities, but we're believers that you can't exclusively focus on those liabilities without taking into some of these other factors. So a lot of time around risk, volatility, downside, but also what we call active risk. So what do things look like relative to your peers? How are other counties invested? We find that helpful for most boards and trustees. What are the Joneses doing out there? From a benchmark perspective, how do things roll up? And we'll spend a lot of time on this later, looking at equities. So not just in isolation, but how do all the pieces fit together? Are there any bets embedded in those relative to the policy? How do they look relative to peers? So you can think about that as sort of active risk, active relative to peers, active relative to policy. From a quality perspective on the right there, that really gets back to our research team. Quality is about looking for best-in-class managers, looking for managers who would be good long-term partners for our clients, and that's a process. So those, initial managers have to go through a process of many years before they can, in fact, be approved for client use. So that team that you saw a couple pages earlier is tasked with doing just that. And again, that breadth and depth of that team, we would really put up, against anyone else or of our competitors in the industry. And then I'll wrap up with costs here. We're big believers that, as appropriate, running the lowest cost portfolio, again, as appropriate. So what does that mean? Number one, ensuring that we're using the lowest cost share classes. In other types of investments, there's no extraneous fees. From an active passive perspective, where do we want to recommend active managers versus passive managers? Because in investments, as you all know, we deal with probabilities, not certainties by any stretch of the imagination. So everything we put in front of the board and trustees, we're not just going to say, hey, we recommend X, Y, Z. What we're going to say is, this is our sort of philosophy and approach. This is what we see based on our analysis. And then these are recommendations based off of that. So this is a shared fiduciary responsibility, obviously, and we feel very importantly about sharing the background behind the proposed actions that we would have you all consider, and in doing so are going to provide the requisite information, analysis, and background around those recommendations. And again, I think we'll flesh that out a little bit more further in the presentation when we get into the next book. But with all that said, that wraps up my intro, but happy to answer any questions or comments that the board may have at this time.
Thank you very much. Any questions or comments?
Do you ever do anything to assess, for example, our collective risk tolerance?
Yes, absolutely. So what we'll do, and I was going to talk a little bit more about, I'm sorry, let me back up for a second. Are you talking about the individual board members' ability or willingness to take risks, more of, say, an individual scoring mechanism? That's something we've done in the past, and we can certainly do so going forward if the board would find that useful. Typically, what we focus on more is data surrounding investment objectives and goals based upon current funded ratios, the assumed rate of return, current asset allocation, and then the risks surrounding the current investments. And one thing we'll talk about later on is alternatives, how they make up a very large portion of the fund, why that's important from a liquidity perspective, why that's important from a sizing perspective, and why it's important from a composition perspective. So, which alternatives should we be using? But to the extent that the trustees would like to or would find useful, some sort of brief questionnaire that would result in a scoring mechanism to try and get the ability to take risk somewhat quantified, we're happy to provide those documents as well.
Thank you.
Mm-hmm.
Any other questions or comments? Great, thank you for the introduction, appreciate it. And so 3B is the Bolton presentation on the SORP actuarial evaluation as of July 1st, 2020, and I believe Mr. Ritchie is on WebEx to go over it with us. Good afternoon.
Good afternoon. I hope everybody's doing well today. Nice to see some people in person in these crazy times. As you can see, I'm actually in the office just because I have to get away from my kids and my dogs. But I'm going to start as if everybody has the actuarial valuation as of July 1, 2020. I am going to start on page 2 and go over the highlights of the results of the valuation. So the first table, the contribution as a percent of payroll from the 18 valuation to the 20, which will be used for fiscal 2022 and 2023, went from 39.9% to 39%. And while it looks good that it decreased, that's a bit of deceiving, because really the reason it decreased as a percent of pay is because payroll went up quite a bit from the last valuation. It went up over the 2 years 26% or almost 13% per year. So what happens when that happens is the components of the contribution are what we call a normal cost, which represents a year of accrual of earning benefits, and then a payment towards the unfunded liability. Any losses in the unfunded liability end up getting amortized over 20 years. So when you have a loss on the liability due to payroll, it doesn't go up proportionally as a percent of payroll because it gets amortized over a 20-year period. So that's really why the contribution went up. But if we go down and look at the liability and the funded status, the market value went up at about a 4% and a 5% return over the last 2 years each year, which was less than our assumed rate of 7.25%. So we got some losses there, though the funded status stayed relatively flat. From 70.3% to a little tick under 71% on a market value basis, and 72.2% to 72.8% on an actuarial basis. And the difference between the actuarial value and the market value is, in order to sort of smooth out the contribution, we reflect gains and losses over a 5-year period, so we don't recognize them all immediately. And as I'll show you a little later, we're kind of we still have losses in the market value to reflect. And hopefully with Pat in there, no pressure, Pat, but you'll bring some gains in so we don't have to fully recognize those losses. Moving to page 3, just something we put in to give you just a relative understanding of the risk of the plan. And this is not good or bad. This is just gives you some perspective just on how volatile the results of the contribution can be as comparison to the size of the plan. So the retiree liability as a percent of the total liability is a little over half now, kind of the same as it was in 18. We call a conservative measure under 50, and this just means, your ability to make contributions to make up losses in investments. It's easier if it comes mostly from active liability because they're still active and they come from contributions towards in the sort of hidden paycheck, if you will, for the pension plan off of active payroll. The more retirees you have in the plan, just the more the active payroll number is going to change from gains and losses in assets. And these next two measures kind of tell the same story. Assets, as the size to payroll it did go down, and again, largely because payroll went up quite a bit. But it's a little under 6, and liabilities to payroll is about 8 times. So that just means as the liabilities move, it can have a meaningful impact on the contribution as a percent of payroll. It's kind of the best measure you have is you're still in a positive cash flow position. That just means that you have more contributions coming in than you have benefits paying out. So you can sort of let the investments ride, so to speak, and you don't have to liquidate investments to pay contributions, to pay benefit payments every year. Now, I am going to move on to page 7. And just a little more, right there. Just a little more detail on the results. So the total participant counts did go up as well. So we had 347 total, and now we have 373. A little bit in the actives, retirees went up quite a bit. We have quite a few that we owe refunds to. Those liabilities tend to be small, so it sort of dampens the impact of the increase in the counts. As you can see, payroll, it went from little under 13.5 million from the last valuation to 17 million in this one. And then just reiterating what I said prior, the active liability is 64 million compared to a total of 139. So it's a little under half of the total liability. That just creates, as you have losses, it just creates a higher contribution as a percent of payroll. The unfunded liability went from Number 5 went from just under 34 million to just under 38 million, so about a $4 million increase. A lot of that was due, again, to the large increase in payroll, which ultimately increases benefits. And the unfunded liability went from 2.6 million to just about 3.1 million. But you can see as the unfunded liability as a percent of payroll did go down, and that's because we amortized that unfunded and those losses over a 20-year period. And then the normal cost stayed pretty level as a percent of payroll, 20.7% to 20.8%. And I'm going to move to page 8. And what this chart shows is just we have an unfunded liability of 37 million, and how do we pay for that over time? Last valuation, we did what we call a refresh or restart, and amortized that over 18 years at the time, and it's now down to 16 years, and we're paying 2.7 million off of that. And then from this valuation, because of the loss in payroll and some increase in counts, we had a and some of the asset performance not being up to what was expected, we had a $4.8 million or $4.8 million loss that we're paying $340,000 a year for 20 years. And then I'm going to jump to page 10. And here, this just shows the smoothing, how we smooth the asset value. And what you see here in the gain loss column is the gain loss we had every year over the past 4 years, and then how much of that gain or loss we're deferring and not recognizing it in the actuarial asset value. And it goes down 20% per year, but we still have almost 2.5 million in losses to still recognize in the calculation of the contribution. I'm going to move to page 11, just give you some highlights just in the participants. So the actives went up a little bit, 194 to 201. Average age did go up a little bit, not quite half a year. Service went up about a quarter year. You can see the average salary really jumped up quite a bit. We had quite a bit of new retirements from 67 to 65. A couple new disabled participants. I think that covers that. And then I am going to jump to page 15. Just on the very end of page 15, plan changes since the prior evaluation. Keep going down a little bit. There we go. Just we made a couple small amendments, really didn't have much impact on the liabilities, but we changed the definition of actual equivalence just to make it a more current table, and then we added a pop-up benefit option as an option in the plan. And how a pop-up works is if you say elect say a 50% joint and survivor benefit, your benefits reduced from the life annuity you would have gotten. But if your spouse unfortunately becomes deceased before you do, or the participant does, then the benefit pops up to back to what the life annuity would have been. And then finally, not in the report per se, but just discussion items. Actually, I will, if we can go to assumptions, let's go to interest rate on page 16. Something we can look for Pat's advice on, but we're using a 7.25% discount rate. That's been about the average that we see in the NASRA survey, but a lot of clients have been pushing that rate down. So I think over the next year or two, and based on what kind of return analysis we might get from Marquette, we might think about lowering that. I think there's still been a trend to lower that down. I think 7% is becoming the most common, and we're seeing clients move down to 6.75 and 6.5. And the comment I'll say about that is when we reduce the long-term rate, obviously the liability goes up, and it appears that the costs go up. But if we can't maintain 7.25 per year, what'll happen is we have losses every year, and the contribution will just start increasing as a percent of payroll each year. So we're going to pay for that at some point. If we can't make that return, we're just going to we're going to increase our burden in the future instead of recognizing what it might be now. And then the only other assumption I wanted to highlight kind of on this page is mortality. We're using, this is a very up-to-date table, but since we started using this table, and this table was published by the Society of Actuaries, and the RP table is largely based on private sector pension plans. The Society of Actuaries has issued public plan tables. They have them in 3 flavors. They have general employees, they have teachers, and they have public safety employees. And I think for next valuation, we would like to consider or like to change to the public safety table, which better represents a group of sheriff officers. So that would be our recommendation, and we would likely see a little decrease in the liability, because the public safety employees don't generally have as good a mortality as kind of the general public. And I know I went through that quickly, but any questions? Anything I can re-review for you in more detail?
Thank you, Jim. Any questions or comments?
I do have one, and you'll have to, I beg forgiveness for not being able to visualize this, but if you were to graph out where we are right now and using the assumptions that you're working with for the future and apply that line against the retirement bulge based on age, is there a point out there at which, let's say in year 10 or year 15 or whatever, we are going to have an immense shortfall compared to what we need to be able to pay out?
No, I do not think so. Generally funding based on an actuarial valuation, you're projected to close that gap over time. There's plenty of assets to cover benefit payments, probably, if you didn't put any more money in the plan, probably another 20 years or so. And generally what we see, sort of the visualization or the graphic of benefit payments, is you see it kind of go up, and then it kind of humps up, and then it goes down significantly. But as long as you keep contributing based on an actuarial valuation amount, you really would be expected to close the gap. The problem you might have, and what would be an analysis that might be worth looking at, is to say, hey, if we kept 7.25 as our discount rate, but we only earned 6.5 over the next 10 to 20 years, what would our contribution pattern look like? Does that help?
Because somebody's got to make that up, right?
Yeah. Mm-hmm.
So I guess what I'm wrestling with is future unaffordability.
Yeah, I mean, a lot of that will depend on, what return you end up getting. And like Pat said, I have to agree, we don't deal in absolutes, we deal in probabilities. And I'd say right now, 7.25, the probability of hitting that over 20 years might be something in the range of 45%.
Great, thank you. I think Pat wants to get in here too.
Yes, if you don't mind. Just quickly, Jim, to your comments, I think it's important also to point out, and you alluded to this, at the end of the day, the costs of the plan are what they are, right? So in other words, we have these assumptions, very well thoughtfully done by the actuary in concert with the board to try and, get to where we ultimately need to be, but the actual experience is going to deviate from that, whether it be from returns, mortality, COLAs, so many different factors. But then at the end of the day, the costs of the plan are what they are, meaning that the county and their has to ultimately come up with the cost of the plan. So we can talk about assumptions all day long and things like that, and what it means if we don't get these certain returns. But at the end of the day, to your comment, Mr. Walters, about a possible shortfall and who does that fall on, falls on the county. So that's an important point. And to your comment, Jim, on page 24, and maybe you can give me a little bit more color, it was helpful earlier on for you to talk about the conservative measure being that the benefit payments are much lower than the contribution. So having that positive cash flow does increase risk, right, from what's called sequencing risk. So not having to draw from the fund at the worst possible time. So when you're in a cash flow positive situation, that's very good. But to Jim's point, Jim, in fiscal year 23, there's a huge jump in benefit payments. So I don't know if that's drop related. I would say I would expect that more in fiscal 22, or what's really driving that, because we could be moving from a positive cash flow situation to, based on these numbers, specifically that huge 2.4 million jump in just a few short couple years, to a negative cash flow situation. So right now we're at 0.7 benefit payments to contributions. I don't know for certain, and I'm sorry for the long-winded background, Jim, but in as short as 2 years' time, I mean, that could be flipped on its head. Is that accurate? And what's really driving that jump in bennies?
Yeah, that I believe is the drop, because we just introduced the drop, and that'll be we had several people join the drop. I'm pulling that up, and I think that'll be the fiscal year we expect the benefits to be paid.
Okay.
Because a lot of these guys will finish drop right in. I think we reflected as coming in fiscal 23. They would be paid. Most of them would be paid in April of 2022, which would be the 2022 to 2023 fiscal year, which is that fiscal year ending 23. So that is drop related. And we have 1, 2, 3.
With regard to the drop program, you mentioned a 50% reduction. Is that the only option?
No. That was just an example on how the pop-up benefit would work. But I think we have the options listed in the report under the plan provisions. And Karen, you might know off the top of your head.
Can you repeat the question? I'm sorry.
Just what benefit options are available?
Well, are you talking about the maximum option and then the 50% or 100% joint and survivor?
Yes.
So you
Yes.
have the maximum benefit. All benefits cease on the retiree's death. That's the maximum option. And then you have a 50% joint and survivor option. And then you have two pop-up options, one 100% JNS and one 50% JNS.
Thank you.
Anything else?
I do. I have a question. Hi, this is Jeanette. Jim, how are you?
Good. How you doing, Jeanette?
Good. We've been funding 40% probably for the last 5 or 6 years. And with this going down to 39, do you think we should change it to 39 or leave it at 40%?
No, I would recommend leaving it at 40%. Payroll did jump quite a bit, but I'd like to see how that gets factored in. And plus, as we said on the actuarial asset value, we still have $2.5 million in losses to reflect in. So I would wait a little bit till you jump down.
All right. Thank you.
Any other questions or comments for Bolton? Great. Thank you very much. We appreciate the report.
Thank you.
Sure. Thank you.
And item 3C, we are back to Patrick Wing from Marquette.
All right, great. Thank you again, Dr. Bridget. So the rest of our discussion will be a part of the other book that you all received in person here on board docs. I believe it's called short discussion materials. So we open that up and flip to page 2, please. Just talk a little bit about the table of contents, the main points we're going to discuss today. Some of these points are ones we'll hit on today because they're first meeting together, ones that won't be nearly as topical later on, but it is important to cover them in detail. So you see number 1, priorities. So, basically talk a little bit about the roadmap as we see it based on our understanding, based upon conversations with staff, but want to share that with you all as trustees to make sure you're in agreement, and if not, what our priorities is as you see them, so we can continue to use this, our time together most effectively. Talk a little bit about the transition update. One key thing I want to mention on that as we move from Morgan Stanley to Marquette Associates. And then number 3, there's some investment fees. We're going to talk a little bit about that. We've been able to make some progress on some of the existing investments, having lower share class options available. So being able to move forward ahead with that and have some fee savings. And then for today, 4, 5, and 6 there are largely interrelated. So today, we're going to take somewhat of a piecemeal approach, focus on the equity segment, the next meeting fixed income, and then alternatives, which will probably be a couple of meetings, to be forthright about that. But want to focus on equities today, and then we'll wrap up with board actions or proposed board actions around them. And then next steps, which will largely be synonymous with the priorities that you see. So let's move ahead to page 4. Again, start on those priorities. So we'll talk about the transition there. In just a minute, the portfolio review and recommendations, again, today would largely be equity related, then fixed income. Asset allocation, particularly alternatives. Talked a little bit about this shortly at 33% target for the fund itself. To be frank, that's very high than what we've seen elsewhere among peer type funds from an alternatives perspective. And so again, based upon our previous discussions, we need to be cognizant about a few things. The composition of those, whether that should be changed, the size of those, as I just mentioned, and then from a liquidity profile. Obviously, that's not a concern today, but in a couple of years, it's going to become increasingly important, particularly with drop coming on board in less than a year from now. So most of those funds have long-term lockups of anywhere between 10 and 15 years. So when you're thinking about 10 years from now, if the fund is moved from a positive cash flow to maybe a negative cash flow position of, I'm making this up admittedly, say 2 to 3% of the fund itself, having such a large portion in alternatives increases that risk that we talked about of having to sell assets at the wrong time to meet benefit payment needs. And that's the last thing you want to do. You don't want to sell equities and things like that after they've declined, because then you're impairing the value of those and they have no time to recover. So that's going to be a big conversation for us. And once we get through that, we'll do an asset allocation study to my comments a few minutes ago. Largely focused around what's there now, equities and fixed, but also alternatives. Again, the sizing, the composition, with all these other factors in mind. Once we're set there, we'll look at the investment policy. That'll largely have to be changed solely because if there are different asset allocation targets, and are there other sort of best practice items that we should work in there. Right now, we're working through some custody evaluation. Your current vendor there, as well as Fargo. We've been working with them and a few other banks on an anonymized basis just to ensure the fees being paid are currently in line with the marketplace. So over time, we expect to have more information for the board to consider there. And then finally, traditional versus OCIO. It's understanding the board would like to learn a little bit more about that over time. Happy to discuss the relative merits of that over time, but for right now, there's a lot bigger fish to fry, if you will. So I would like to focus on those items. And then over time, again, up to the board, you'd like to revisit, happy to do that. So if we can skip gears and talk into the transition update, I'm just going to spend a quick minute on this page. It's been largely similar to most of the new clients we've come across, and the tasks you see on the left here are pretty consistent with what you would normally see. The biggest difference there is in blue, sort of the second up from the bottom. So taking a step back for a minute, the previous relationship with Morgan Stanley is very different than what we've seen in the past. They are very much more involved from an operational, administrative, and logistical perspective. So what I mean by that, and you can see what we need to do here, is right now they're involved in many of the functions that a typical custodian bank like Wells Fargo would be handling. So some of the trading is being done through Morgan Stanley. They're producing some custody statements that would typically just be done by the bank. I don't know what else on here. Importantly, the distributions and the capital calls for some of those alternatives, normally that would just be a function of the bank. When distributions come back from those managers, we're wired right back to Wells Fargo. And then when calls are being made, when funds are going to the managers, Wells Fargo would be making those wires. Right now, it's all happening at Morgan Stanley, where anytime there's a call, these managers are just debiting the account there. And anytime there's a wire, it's going back to that account. So over the next few months, long-winded way of saying, again, they're much more involved in many of these functions that are typically handled by a bank. And we are looking to, for lack of a better word, remove them from the process, because these functions can and should be done by Wells Fargo. We're trying to move away from Morgan Stanley. We'll do it prudently over time to ensure there's no disruption. But over the next 2, 3, 4, 5 months, that's where we're going, and that's where we're going to be. So Wells Fargo is doing what they should be doing. We're doing what we need to be doing, and you don't need any other parties to do that. So it's a little bit more integral and detailed process that we normally come across. So that'll be a big project over the next few months.
I have a question.
Yes, sir.
I'll be right up front. I have a heartburn about the term Wells Fargo. Comments?
I was waiting for the question, but yes, I have some comments. So Wells Fargo has many different business lines, as you know. They've gotten burned, rightfully so, on the consumer part of their business. From a custody perspective, we found them to have pretty good service over time. Now they are also, as again, you all well know, going through a merger with Principal. So the timing of that going through is still a little up in the open. What things are going to look like is still up in the open. And to my earlier comments, that's one of the reasons we're looking at custody right now. So not only have we worked with Wells Fargo, but we've also been talking with a couple other banks that are well known in the Maryland space that we work with that are very competitive on fees, to determine whether it makes sense for the county to move away. Because we don't want to just think about SORP. We want to think about OPEB and LOSAP too, because when you have scale, you can really drive fees down and without sacrificing customer service, because we're talking about a doubling in the assets. So right now on an anonymized basis, not only we're talking with Wells Fargo, but also US Bank. I didn't mean to name them, but I just did. But it's anonymized. They don't know it's the county. US Bank and Wilmington Trust, who is prevalent all around here. So we're gathering that information. We'll share that with the board, and then up to the board to determine whether or not to just go back to Wells Fargo and say, you guys got to get here, or to go out to a procurement process. So that's something that we are working on, and we'll have more information on in short order.
On the retail side, their corporate reputation has taken quite a hit over the years.
To say the least.
And on the institutional side, check me if I'm wrong, did we not get sent a check for a little oversight on their part to the tune of 4 years' worth of money they should not have subtracted from our account?
Yes, we did.
I do not, just so you know up front, I don't have a warm fuzzy about Wells Fargo.
Understood. And that's one of the things, whether or not there are...
I'm only one vote.
I understand whether or not there are similar feelings amongst trustees. We always look at third-party vendor relationships from a fee perspective, from a service perspective, to see if there are better options out there, because, admittedly, it's a commoditized type of business, right? There's not a heck of a lot of differentiation unless you have these issues, right, of overcharging, different business lines, sort of headline risk. So in our initial discussions with staff, we found out that this was very important. We've begun to get that information. We'll be able to share that with you in short order and then leave it to you however you best see fit to move forward.
Well, not to steer you, I have slightly less concern about costs compared to my concern about corporate integrity.
Sure. Sure. Well, I think, it's possible you could, kill two birds with one stone there, depending on the outcome of some of these findings, which again, we'll share with you and, lean on to you all about how you would like to move forward with that.
Okay, thank you.
And then if I can just add, that was one of the factors in the RFP, because we all felt that that was important to consolidate for the 3 different trusts, but then also the concerns about Wells Fargo and the transition to principal.
Should we have them looking for alternatives now then?
Well, that's what Pat is doing.
Yes.
But then we would have to decide whether we would need to go through an RFP process, what it looks like in terms of procurement, because there's some thresholds for costs that might guide how we have to act, and we would need to discuss it with the other boards as well.
Aren't we obligated by law to go through an RFP?
I think the procurement manual, it depends on the amount of the contract, the process.
I can't imagine it being under any threshold that's in the procurement manual.
So we'll look at all of it.
Right.
No.
Okay, thank you.
So that's actually a good point, Mr. Walters, to segue into our next section, starting on page 8 in investment fees. So to echo my comments earlier, that's one of the 3 key pillars that we take a look at. So at the outset of any relationship, take stock of the current investments, particularly mutual funds, and say, what share classes is the pension fund invested in, and are there any cheaper share classes available? So there's a lot of detail on this page, but at a high level, the fund has 4 mutual fund investments, 2 on the equity side, 2 on the fixed income side. 3 of those 4 had cheaper share classes available. So our team back at the ranch did an audit, told me what the share classes were, and then we went to Wells Fargo and said, these 3 funds have 3 cheaper share classes. Is the sheriff's pension fund have access to them? They said yes. So these were executed last week. So it's the same mutual fund, same investment strategy, process, and everything. The only difference is the fees. You can see those annual fee savings at the bottom of that blue, purple, and we'll call it tan to the right there. And then, so in summation, we did those share class conversions, or, we submitted the instructions to Catherine to submit to Wells Fargo in excess of about $26,000 a year, just by changing share classes. So
just to be sure I understand the chart,
Yes, sir.
Look at the left grayish thing, whatever. It was 65% or 0.65 for a iShare,
yes, sir.
and you moved to R6 for a 0.5. Was the difference a 12B1 or just plain cost?
Just plain cost. So those operating fees that are in there, slightly lower management fees, neither had 12B1. Those are found more in the, as you I'm sure know, in the A, C sort of share classes. So none of them had 12B1. No, sir. You're asking good questions, Mr. Walters, that are segueing us into our next discussion, because while those funds did not have 12B1 fees, what we have also done, and we're a little surprised by our findings, is not just looking at the mutual funds, but other investments within the SORP fund to do a fee audit. So right now, outside of your traditional fixed income and equity mutual funds and ETFs, there are a number, as you rightly know, of alternative investments, about, call it 25-ish or so alternative investments spread across real estate, private equity, private credit, infrastructure. So we started with the private REITs because they are the sort of easiest to dig up the information. So as you look at page 9, I'm going to run through about 5 of these 25 alternative investments, and I'll pause here after page 9 to see if there's any follow-up. So this page lists 3 private REITs. You see them again there in blue, purple, and again, we'll call it beige there to the right. Each of these managers, or each of these investments have share classes like mutual fund. They have 4 share classes. Each of the 4 share classes have the same management fee. There's an iShare class called an institutional share class, where that is the only management fee being paid to the investment manager. There are other share classes that have additional fees. As you can see by this language here, if you look at Black Creek all the way on the left, for instance, the management fee is 1.1% for this S share class, which the fund is in. But it also has an 85 basis point trailing fee.
To whom?
According to the investment managers, the investment fees are paid to them. Any trailing fee that you see for Black Creek, Blackstone, and Starwood is paid to Morgan Stanley. So what we're looking at right now is converting these 3 share classes. So Starwood on the right there, we have worked with them. We can just convert the share classes from S to I. We can have those assets moved, custodied from Morgan Stanley to Wells Fargo. That is in process. If you look all the way to the left there, you see Black Creek. It's another private REIT. They told me that you cannot just do a share class conversion. That can only be done in the first month of the initial purchase. So what they have advised me to let you know what the option is there can be a full liquidation of that share class, and then a subsequent purchase of the iShare class, which would effectively get rid of that 85 basis point fee. And then for the middle Blackstone, what we've been told is that you can also do a conversion similar to Starwood, have those assets moved from Morgan Stanley to Wells Fargo, but that's a little earlier in the process than it was with Starwood. So our key takeaway here is each of these 3 funds had the management fee, which is shown there. The S share classes had an additional 85 basis point fee, which according to the managers is going back to Morgan Stanley. But once we're able to change those share classes, you can see the annual fee savings down there. Eventually, I would hope over the next 3 or 4 weeks, we can shave $55,000 off of those costs, because I didn't mention it in our opening, but we are an independent investment consulting firm. The only fees that we're paid are by our clients.
So to be sure I understand you.
Yes, sir.
In the gray box, the first one, as an example,
Yes, sir.
you can't change without, well, you had a window where you could have changed to a different class.
Of 1 month, yes, sir.
That's long gone.
Yes.
You can't change without exiting that share class and then re-entering another one?
It would be the same fund,
Yes.
yes, but a different share class that you can re-enter after a liquidation.
Why is that not an exchange? Why do you have to get out and then get back in?
Because the exchange itself is not an option. You can only do it within the first month. What they're saying is that it would have to be a full liquidation, then subsequent purchase. So in essence, it would be an initial allocation to a new share class.
So then, are you folks going to apply any kind of scrutiny to these as to whether or not we should be in them at all? Maybe an exit is an exit.
Oh, yeah, absolutely. So as I laid out earlier, sir, we're looking at equities today and any other fees where we get nicks, and we're going to look at fixed soon, and then we're going to look at the alternatives. So without saying, because, as you know, this can't happen in a vacuum, right? If we exit, the money's got to go somewhere.
Right.
So we're still in the fact-finding process on the alternative side, so we don't have a good recommendation about where the money should go. The relative merits of the initial funds themselves, we will then report back to the board to say, hey, even at this 1.1%, because if you see at this footnote, they also have incentive fees. Do they make sense for the fund? And if not, what makes better sense? And at that time, which, we're not talking about 2022 or 23, we're talking about later this year, then we'll have that conversation.
For the record, would you explain that footnote, please?
Oh, yes, sir. So it says does not include incentive fees. So many of the alternative investments have what's called a performance fee, or an incentive fee. So what that is saying is if those funds make more than 5% in any given year net of fees, then they are entitled to those additional profits. So say one of the funds made 6% net of fees, so net after that management fee, that's above the 5, which is called a hurdle, and then they would be entitled to 10% of that difference between 6 and 5, if that makes sense. So your net return was 6, it's above the 5, that 1 percentage point difference, they're entitled to, say, 10, maybe even a slightly more of that 1 percentage point. So your net return is no longer 6.
And again, to
It's lower than
clarify, the "they" being who?
that would be the investment manager. So the only indirect fee that doesn't go to the investment manager is what's this trailing fee here. That goes to the financial advisor. The management fee and the incentive fee goes to the investment manager itself. But those incentive fees are not as attractive to shareholders that we typically see out there. So to your earlier question, yes.
Nor
we're gonna-
are they as transparent to the client.
I would agree with that.
Thank you.
Yep.
This is not a congressional hearing. I'm not trying to.
Oh, no, I understand. It's a delicate situation, and I want to answer it as openly as
You're doing a good job.
I can, so
Oh,
I
thank you.
appreciate that.
And Pat, maybe pause for a minute. I don't know if Sergeant Moses or Sergeant Safford have any questions. It's a lot of information. Did we lose them?
Are they still with us?
Okay, Ms. Patson.
Can you both,
No questions from Sergeant Safford.
Sergeant Moses?
No questions from Sergeant Moses.
Thank you. We've had the benefit of having multiple conversations with Pat over weeks trying to digest all this, so I know it's a lot of information, so thank you for that.
Absolutely. So more to that point, if you could skip ahead to page 10, and we'll circle back later on to the proposed board actions, specifically as it relates to to Black Creek. And really everything we talk about today, we'll lay through it out, and then we have a page and say, these are the actions we would like you to consider. So we'll circle back. So on page 10, in a related vein, there are also 2 other Blackstone private investments. The one in the blue there is also a private REIT. Right now, it's in liquidation phase, meaning that about 12% of the fund was liquidated and wired back to the pension earlier this month. In the beginning of the second quarter, a larger portion of that fund will be liquidated and sent back. The beginning of the third quarter, the remainder of the fund will be liquidated and sent back. There is no management fee right now. There is no trailing fee right now because it is in liquidation mode. However, I wanted to point out to the board that I was told it did have a trailing fee when it was in existence previously. On the right is another Blackstone investment, and this is a little bit of a different animal. So when you have those 25 alternative investments, the 3 on the previous page and the first one on blue on this page are private REITs. So they have monthly liquidity. They are private vehicles, so not a mutual fund. But there's no, as an investor, you control the cash flows. So you can contribute, you can redeem as you see fit. The vast majority of the other alternatives are what's called closed-end funds, where as an investor, you make a commitment to the fund. The manager will draw down or call that money from you over time as they see investment opportunities. Could be 1, 2, could be 3 years. And then over the back end after that fund, as they realize and sell companies, then they start to return money to the investor. So if there are 25 alternatives, we have 4 private REITs, which I talked about, There's a smattering of hedge funds, but then the vast majority are these closed-end fund vehicles. So what we've also learned is that despite them being a little different in nature, that many of these firms, sort of the big players, you have a Blackstone, right? Huge player. There's a Goldman Sachs, there's HarborVest. So these are names that we know, but we know on the institutional side of those firms. These agreements, so you see here the Blackstone GSO Secured Lending Fund, that was made through the private client side of Blackstone. So when I talk to our contacts at Blackstone or Goldman or HarborVest on the institutional side, it's like a left-hand, right-hand thing, right? Where they're saying, we have no idea. We got to talk to our private client group. And then on top of that, those private client groups have selling agreements with, sort of financial advisors that can then limit some of the information to be shared. Long-winded way of saying I didn't expect to see these sorts of things on these closed-end fund vehicles. When we look at Blackstone, that is a vehicle that has called all the capital. It's eventually, and it has a trailing fee that's being paid to the financial advisor. It is going to go public in about 12 months. Until then, we have basically no option. When it does go public, then we can take a look at the relative merits of that within the construct of the fund itself, similar to the other REITs.
Are you saying, and I'm not arguing in favor of this, but are you saying that because they are so close to going public, we could not sell those holdings to somebody else? Exit the position?
It's very, very unlikely. So there's, and I apologize if I'm telling you anything you already know, within the alternative space, a thing called secondaries, where you are a primary investor in the fund, so an initial limited partner. If you wanted to exit your interest in the partnership, you could sell it to another party. Okay, that's called a secondary transaction. When that occurs as a seller, you're at a disadvantage, right? Because you want to get out. So you typically take a haircut on what you've sold. So that's a big drawback in moving in that direction. That would be the only option, and to be quite honest, I don't know that it would even exist in this type of commitment that's so small. So for Blackstone right now, the options that we have would be to wait until it goes public. And at that time, unfortunately, the trailing fee, even though it would be public, I've been told would still be on. So then we can revisit it and liquidate it then to get rid of those fees as appropriate. And I also, just quickly before we move on here, so now we're talking about 20 almost alternatives left, right? Where we've begun to dig deeper into this, and most of them are these closed-end funds, like the Blackstone one. So I had a conversation with HarborVest actually on the way down this morning, and it was a similar type story. I'm talking to the institutional side, where the agreement is through the private client group for HarborVest, because they have the selling agreement with Morgan Stanley. So what I was told was, from an investment management fee perspective, it's 1%, which is really what all investors face. But then on top of that, similar to Blackstone, there's a 75 basis point additional servicing fee, if you will, not going to HarborVest, but going to the financial advisor. So they are getting back to me about any options that the board has to lessen or eliminate those fees. So, again, apologies, long-winded explanation of some of these things, but as I mentioned about getting Morgan Stanley kind of extricated from some of the logistical and operational things, really digging and getting to the bottom of a lot of these issues is going to take time. So I would ask for your patience. We are going to get to the bottom of it, and we're going to get it right. But it unfortunately is going to take a little bit of time to dig under the hood under all these issues.
I'm not going to hold you to this, but what would be your best guess for working through those questions? 6 months? 3?
I would think somewhere between that window, hopefully on the shorter end of that window.
All right, thank you.
That is my hope. You know, we've made some progress already, and we continue to do so, and we will report that progress at each meeting moving forward. Okay? Any other questions around that? Okay. Okay, so if we shift gears now to the next section, this is going to be largely around the analysis and the recommendations for the board to consider today. So like I talked about earlier on, you know, we won't just look at the individual managers themselves or the relative merits of an individual manager in that space, but we think about the risk, the bets, you know. So what are the bets relative to peers? What are the bets relative to policy? So peel back that layer, put all the pieces together, and then what do the exposures look like? So that's what we've done here for equities today. So if you skip ahead to page 12, we'll talk about some broader observations and then show you some data and analysis behind that and some things to consider. So broadly, you see at the top, U.S. equity structure reflects a pretty large bet on growth in mid-cap stocks relative to policy. And again, we'll show you that data. On the international side, very large bet on growth stocks relative to policy based on the structure of the individual managers, the respective investment processes. And then finally, there's a lot of active managers across the U.S. and non-U.S. space. So based on some of the data and analysis and recommendations, there's going to be some recommendations about culling some of the active managers and particularly in more efficient areas of the market, and looking for some maybe other lower cost substitutes in some other areas, but we'll work through all that. If you look on page 13, you know, one of the interesting things, right, is you have right now Kayne Anderson small mid-cap core manager. So this is a manager we like very much. But when you look at their name, right, it says small mid-cap core. So you would think right down the middle of the road, right down the middle of the fairway, sort of not tilted towards value or growth. But if you look at the chart via Morningstar, they are very much a growth manager. Now, that's not a problem because we know their investment process. They look for high quality growth companies, but at face value, when you see SMID core, you would think right down the middle, right? No tilt towards value and growth. So it's really important, again, to look under the hood for these managers. And then when we roll them all up, as you see on page 14, we can look at the respective tilts, the respective bets. So a lot of data on this page. When you look at these, say the black box to the left, this is your total U.S. equity, a weighted average holdings-based analysis to show, you know, where are you tilted towards value stocks, where are you tilted towards growth, and then from a size perspective. So we're really concerned about with the totals. So on the left box there in black, towards the right, the further right column where it says total, if you look from top to bottom there, specifically mid and small, right now you have a 36% allocation to mid, 6% to small. So basically 6-to-1. Mid and small. And if you look over to the right, that box is your policy right now, which is 73% S&P, 15% Russell 2500, which is a mid-cap index, and 12% Russell 2 small cap. But if you look at the relative weightings between mid and small, it's basically 1-to-1 from a policy perspective. So what does that mean? That's these two rows at the bottom where it shows the difference of your actual less your policy. So on the left there, we show the style, huge overweight to growth stocks, right? 9% underweight value, 8 core, 17 growth. From a size perspective, pretty much in line with large, huge overweight mid, huge underweight small. So, you know, this is very important from, we believe more so from a style perspective, and why that is on the next page. You know, why is this important? As I'm sure you all well know, growth stocks have absolutely outperformed value stocks by an historic margin over the past 3, 5, 7, 10 years. However, these things are very cyclical over time, right? We have mean reversion, you know, where Some things are in favor, some things are out of favor. Obviously, we need to understand the environment. We need to understand, what could be different this time. Very important part of the puzzle. But just to show you the historical record here on page 15, we're showing in blue the relative performance of growth and value. So if the line's going up, growth is outperforming over the previous 10 years and vice versa. So you can see the cyclicality, the mean reversion, but all the way to the right there, over the past 10 years, the outperformance of growth has been even bigger than in the dot-com bubble back in the day. So as we think about current exposures, which had worked well, but when we think about, the probabilities moving forward, we would argue that taking some of that growth tilt off the table would be in the best interest of the fund. So in the recommendations we get to shortly, some of the changes that we were going to make is certainly to mitigate that growth overweight of 17% that you saw on the U.S. equity side, to bring that down more in line with averages. Let me pause for a second. Any questions or comments before I continue?
Could some of that overweight be because of the return?
This is just based on some of the overweight could certainly be because of the return. Obviously, we took the latest values to calculate these numbers. So as the values have changed based on market conditions, the overweight would have changed in sympathy with that. Absolutely. But then again, I don't know if this structure as it stands now was the same structure 2, 3, 4, 5, 10 years ago. So it could have been a result of market conditions, but it could also a result of any changes that the board has made over time.
Because those things shift a little bit, what are your thoughts on the guardrails against a target and what it would take to do a reallocation, a rebalancing?
So typically you would look at that at the asset class level, as I'm sure you rightly know. One of the big things that we like to do is take a look under the hood, right? Peel back the onion here. So I don't know if you were getting this sort of analysis at the past. So our job as we see it is the board cognizant of this? If yes, okay. Are they still good with it? If no, let's bring it to your attention, and do we need to do anything to remediate it? So I would say, to answer your specific question, Mr. Walters, that the guardrails are not necessarily set in stone, but what we see here on page 16, based upon these relative weightings, this is a massive bet towards growth stocks relative to the rest of the market. Massive bet towards mid-cap. So we're not advising you, which we'll see later on, to eliminate this completely, but we think it would be prudent, again, against we're dealing probabilities, just to mitigate or lessen those tilts to some degree. Okay. So if we look on page 16, just quickly, this is the same data for the international equity structure, so I won't run through it in great. If we just look at the bottom rows, the differences actual versus policy, you can see towards the left, from a style perspective, it's the tilts are even more exacerbated, if you will, from value, core, and growth. Growth about 24% overweight relative to policy. So a very big tilt towards growth stocks, again, based on the initial structure. And then if you look to the right from a size perspective, something like that, just 7% underweight large, distributed amongst mid and small. That's not terribly concerning. What's concerning is really the style perspective. So we'll talk more about the recommendations, how to mitigate some of those tilts shortly, but as a part of the discussion of our recommendations, as I mentioned earlier, passive versus active on page 17, one of the things that we like to do to the extent possible is to provide you context from a peer perspective. So what are your peers doing in whatever space it is? So we thought, we'd bring up the active passive discussion today, so we'd provide you some peer data to help you, consider some of these recommended actions. So here you see we've anonymized some Maryland, PA counties across the board, but where you see in the columns under U.S. equity and international equity, that is the respective allocation within those asset classes dedicated towards passive investments. So just quickly, you see Maryland County A there. What that's saying is, of their target to U.S. equities, they are fulfilling that target 2/3 through passive managers, only 1/3 through active. And then same county on the right, international, for their respective international target, they are filling that by using 22% passive and then 78% active managers. So a wide range as you work your way from top to bottom here. So we think the average is probably a little bit more instructive when you get to the bottom. So the average of these 18, 19 counties above is that about 61% of their U.S. equity allocation is met via passive investments, and then on the international side, about 27%. So if you look at the SORP fund there below, you see it's probably about 50-ish% below the average on the U.S. side, and then about 33% below average on the international side. And I would also mention, based on our earlier comments around alternatives, that the counties that usually have a bigger allocation to alternatives tend to have more passive investing. And the reason that is think about it as a fee budget, right? Alternatives, by definition, are going to be more expensive if they have the scale and access to have large exposures to that area. They know they're going to pay more, so they tend to be more more passive on the traditional equity side to sort of maintain an appropriate fee budget, if you will. So look on the next few pages. I'll walk through this pretty quickly on page 18. So I showed you, the numbers themselves. So, where does it make sense for the board to consider in these various markets where to be passive and where to be active? So the next few pages are largely the same data for each respective market segment. So we'll start with U.S. large cap here on 18. So what we're showing here, if you look at the white rows in the table, those are the median net performance of large cap U.S. equities in core, growth, and value respectively. In the gray rows, those are the respective benchmarks. And then you see the returns across the respective time periods. And anytime anything's in red, there's underperformance. The median manager net of fees is underperformed, and in green, vice versa. So again, getting back to our conversation around probabilities, right? And, being thoughtful about the recommendations. The U.S. large cap space is one of the most efficient parts of the equity market, right? It's hard for managers to gain an informational edge, right? The information on these companies are readily apparent to everybody. So then not only do they have to outperform their peers and the benchmark, but they have to do so net of fees. So when you're operating in a very efficient market and you're charging 50, 60, 70 basis points in fees, it's really very, very difficult to outperform your respective benchmark, particularly in this space, given it's so efficient. Now, when we think about a better sort of a more favorable story where your probabilities increase, number one on 19, that would be the U.S. small cap space. Admittedly, it's the same analysis where we're showing the net of fee median performance relative to the benchmarks. But one of the reasons small cap managers have a better go of it is, number one, they have a bigger opportunity set. So when you think of large caps, it's a smaller opportunity set where small caps have a bigger one, and there's less information available out there. There's less people tracking these companies, following them, so it's easier to outperform. And you can see that that's borne out in the numbers, particularly in the U.S. small cap growth and small value space over the intermediate and long term. And then finally, wrapping up on 20, switching gears back to non-U.S., again, the same type of analysis on page 20. We're showing non-U.S. managers relative to their respective benchmarks. Again, the median performance net of fees relative to the benchmark. So anytime you see a green number, that means that's representative of the 50th percentile. So therefore, more than half of the managers have outperformed. So anytime you have more than half of managers outperforming, just by definition, you're choosing from a pool of managers greater than 50%, so your probability of selecting a manager that can outperform is just by definition higher. So this is a little background on, when we get to the recommendations in the next section, not only we're going to talk about mitigating or decreasing some of these tilts, but some of the manager changes will be largely a result of changing the active, passive allocations within certain market segments. So we're getting close to the end, I promise here. If we start on page 22, what you'll see is the whole retirement fund allocations, and I apologize for the print. There are many, many investments, and it can be difficult to get it on one page. But before we get into the recommendations themselves, it's important to note, if you look at the bottom box to the right here, where it says post-rebalancing allocation. So this is all the way down towards the bottom right. And then the respective asset classes that are approved by the IPS are on the left. Importantly, what the IPS currently calls for is equities being plus or minus 9 percentage points of their respective targets. So if we sum up the differences all the way to the right, where anything in green is overweight and anything red is underweight, right now we're about 12% overweight equities relative to policy. So we're outside the investment policy statement ranges. So when we talk about potential changes, that's going to be a key component of the board actions to bring those back in line with what the policy statement is calling for. Does that make sense? Any questions?
I think I follow you verbally, but I'm lost on the page.
Which parts?
Use that same example again, and I'll try and reorient here.
Okay, so on the top table is all the individual investments. A lot of the privates we bucketed individually. So if you look at the top part of the table, so we have the fund, we have the ticker when it's a mutual fund or ETF, the total assets, which is just a summation of everything below, the allocations, obviously the same sort of story, any proposed rebalancing, which we're not showing on this page, we'll show later. So therefore, the total assets are the same as the previous column. The allocations are the same. And then all the way to the right, we're showing the targets per the investment policy statement. When you look at the tables below, they'll be the same because we're not proposing any actual rebalancing. So just focus on the one on the bottom right. So you see the respective asset classes listed on the left. The under portfolio, those are the actual allocations across each respective asset classes as of January 20th. In blue are the respective targets per the IPS, and then the difference to the right are the relative over and underweight. So if you see a number in green, that means you're overweight, and a number in red, you're underweight. So just to echo my comments on the IPS, right now for global equities, which would be U.S., developed, non-U.S., and emerging markets, you have a range of plus or minus 9%, but if you add 8.6, 4.16, and subtract about 1%, where you're really at is almost about a shade under 12% overweight. So you are outside of the range right now, is my, the takeaway for this page. So when we talk about what to do, it's not just going to be mitigating those tilts that we showed earlier, but also we need to bring things back in with the current investment policy statement. So if we look on page 23, the next couple of pages, what I'd like to do is walk through our specific recommendations based upon the analysis and discussions that I shared. And then on page 25, I believe it's the actual sort of rebalancing that the board will hopefully consider. So if we look on 23, there are a number of manager terminations that we're recommending and the reasons to the right. So the first four are in the U.S. equity space. The first is an iShares Core Dividend Growth Fund. This is a ETF that targets one area of the U.S. large cap market. And given the market efficiency that I showed a few pages earlier, we think these assets would be better served in a vehicle that has a lower fee base because, again, it's very hard to outperform in that market. The second one, the Columbia Dividend Income, this is your large value manager, but if you think about it like what I showed with Kayne Anderson, even though Kayne Anderson is core, they actually have a growth tilt. It's similar with Columbia, even though they're value, they're closer to core than they are to value. So that's exacerbating that growth tilt, if you will, when we think we're getting value, but we're not exactly. So again, we think it would be prudent to consider a change there. Also they are a U.S. large cap manager operating in a pretty market efficient space. And then if we move to a passive, obviously it'd be lower fees. For Kayne Anderson, their small mid-cap core, I showed that huge small cap overweight earlier on. They do run a portfolio just focused in the small cap area. We like this manager, so we're just simply going to look for a change in mandate. So no longer SMID core, but small core. So a pretty straightforward change there. The fourth one down, iShares Core S&P, there's only a 0.5% in that fund at all, so it's a material allocation as I listed there. I think it'd be prudent just from a simplicity perspective. It's not really making an impact with the fund to just remove it from the portfolio. So then looking at international equity markets, we have two here, Hartford Multi-Developed multi-factor developed markets. That is in the international space. It's a fund that has a fee of about 30 basis points, tends to be more core-ish, has not done very well at all over the years. So when we think about, passive active in international, we think a decent or a sizable portion in international should be passive. So we think this is a good, a sourcing for those funds to move passive. And then finally, KBR International. This is a similar story to Columbia. They're your international value manager, but they are closer on the core side. So again, they're exacerbating that growth tilt. And then with that, if we can move it to a different international active value manager, it would come at a cheaper cost too. Any questions about any of that before we look at page 24 additions?
So you haven't talked about returns on any of these, and I know you focus predominantly on fees, and I appreciate it.
Yes.
And have appreciated the opportunities for us for savings. But the alternative side is that sometimes you pay fees because the returns are worth it.
Absolutely.
And so I haven't seen that analysis done. So can you talk to that a little bit for us?
Sure. So we're trying to accomplish two things, or there'll be two big changes, if you will, when you think from a broad structure, right? We're decreasing the growth allocation and decreasing mid-caps to some degree, and then obviously, like you said, saving on fees. So, more broadly, if we look out over the intermediate and long term, given the strong performance that growth has had relative to value, we think value is more favorable looking forward from a return perspective. And admittedly, anything can happen in a quarter, a month, as we all learned very well last year. A month, a quarter, even a year or 2 years. So we're big believers that valuations drive subsequent returns. So just like you buy a house, if you pay more than you should, your return's going to be less. You pay less than you should, which hopefully we have, your return's going to be more over time. It's the same thing with any sort of asset or security. So given the growth outperformance over the years, they are expensive relative to value stocks. So if you look out 7 to 10 years, we would expect value to do better. So therefore, not just lower fees, but also higher returns.
Okay, great, thank you.
Any other questions I can answer before moving on?
It doesn't sound like it.
Okay. But maybe they're holding to the end.
I'll suppress it.
You'll save it.
Yes. Say,
So summary additions here. So obviously some termination recommendations. So where does the money go, right? So one of the things that we would recommend would be the Vanguard Value Index. This is a large cap value index. The reason, similar to Columbia, would be market efficiency and reduction in fees. The Virtus Kane Anderson Small Cap Core, again, you have the SMID now. We do like the manager, but we would move it to core to decrease that mid-cap tilt. A couple of new managers presentations, and I did provide some memos I think were posted on board docs. They are inserted in the back of your book. I won't walk through them in detail, but the first I'll mention is ISCM Small Company. That's Investment Counselors of Maryland. Small company. They are located in Baltimore. They're a shop that focuses exclusively on small and mid-cap value stocks. The team's been around together for a very, very long time. And as you can see in the memo itself, strong long-term investment process, strategy, and results. It is a top pick from our analyst group for active small values in that space. And then importantly, which I always like to share, is we also have 4 clients invested in the strategy with more than $70 million. So sometimes clients tend to find a little bit more comfort that they're necessarily not going to be the first one in that strategy. We have a long-term relationship with that firm. Fidelity International Index, again, this would be somewhat of a substitute for that Hartford multi-factor, decrease that growth tilt, lower some fees. And then finally, Schroders International Multi-Cap Value. This would be a substitute for KBR, who's more of a core type manager. They're more of a value manager. They are located in London, which we do think is a positive. If you're in international markets, having boots on the ground, they do have offices stateside as well. But having boots on the ground in the international markets, if you're going to invest in those companies, in those securities, we do think is somewhat of a competitive advantage.
is that their only overseas location?
No, they do have many others. I believe it is listed, Mr. Walters, in the memo itself. Happy to take a quick look. Let's see here. Let's see. They have offices in 37 countries across Europe, Middle East, Africa, Americas, and Asia Pacific.
Thank you.
Their lead PM has been in place for about 26 years. They have 34 analysts working on it, and similar to ICM, very strong returns from a risk-adjusted and absolute perspective over the years. They are also a top pick of our research team, and we have 50 clients invested in the strategy with about $100 million. The other quick thing I'll mention on them is they have a commingled fund available, which would be our recommendation. So this is something, it wouldn't be a straight mutual fund. It would have the same team, liquidity, process, strategy, just less fees, because when you have a mutual fund, there are many other operating regulatory fees that come into effect. So their mutual fund is about 77 basis points, whereas the commingled fund is 55 basis points, so about 30% cheaper. So on page 25, what does this all mean here? What are all the moving pieces? And admittedly, there are many. So anytime you would have seen a termination, that's just liquidating the full amount of the fund itself. Some of the funds, when you look at the rebalancing column in that middle of the page, are just more or less a trim, specifically in the international space, where you see PGIM all the way towards the bottom. They're a strong growth manager, which we think very highly of. So we would be proposing the board essentially cut that allocation at half, but the vast majority of the changes are the new managers and the terminations that I listed on page 23 and 24, but also in order to get the fund back in line with the investment policy range. You can see at the bottom right here, where previously you had about a 12% overweight to equities, these changes would bring that to 8.6%. But also importantly, what mirrors that overweight is the alternatives, second up from the bottom, where you're underweight by 8.5%. And that's pretty much a substitute. From a long-term risk and return perspective, we think having that overweight to equities and the underweight to alternatives makes much more sense than having an underweight to say, or an overweight, to fixed income compared to equities, which would have much bigger implications to your expected return, your expected risk, and things of those nature. Any specific questions on page 25? I know there's a lot of moving pieces on this page. As I mentioned, some money going to cash to kind of build that up for capital calls, and some money moving into fixed income as well.
So everything on page 25 that you're going to harvest, and we see in red, some will go to cash,
Yes, sir.
and the rest will go across the funds we see on 24?
Yes, and then one other one I should mention within fixed income, to the Delaware Diversified Income Fund, which is a little bit more conservative than Loomis. The county has exposure to Delaware Diversified Income Fund and the OPEB as well. We like that fund. The Loomis fund is different than the one in the OPEB fund, but when we take a look at fixed income structure next month, I don't know for certain, but we may have a recommendation around Loomis. They've had a long-term portfolio manager by the name of Dan Fuss, who has announced his retirement and is moving away. We still like their team, but, we think there are better options out there. So I don't want to add money there and then box ourselves in from a round-trip trading perspective. We might need to give them money today and then take it away in another month if we so choose to do so. And just given the strong run the markets had yesterday notwithstanding, adding the money to a little bit more of a conservative fixed income manager of the two, I think would be more prudent.
And the distribution of the totals in red are not necessarily going to be equal across all the recommended additions. They will be proportional to get everything the way it should be?
So what we would do is keep the purchases as they are would like the board to recognize that the liquidation amounts could very well be different based on what's happened in the market.
Right.
Yes, but the purchases themselves will keep as they are. And if we find ourselves in a month again sort of teetering on that policy range, then, we'll make those recommendations at that time. But the actual liquidations would be dependent on market conditions unless they're a hard dollar amount, similar to the purchases, unless,
You're not pulling the trigger on the sell side now? It's not what you're recommending?
no, I'm sorry if I misspoke. What we'll do is we will work with Ms. Pratson and her staff to get everything executed. So we will move forward beginning tomorrow, should the board approve this.
So just to clarify, Mr. Walters keeps saying in the red, but there's also numbers in the black in rebalancing. So it looks to me like you have both the additions and the terminations in the summary page on 25 in
Yes.
the rebalancing column.
Yes. I apologize if I misunderstood. Yes, thank you.
I just
for-
wanted to clarify both
Yes.
sides of the equation
Yes.
appeared, because the reds, are the decreases,
Yes.
and so they go to zero, but the additions remain black. They weren't bolded or highlighted in any other way. So it's that column, I think, and it's the recommendations on both the terminations and the additions that are reflected in page 25, correct?
Yes.
So looking at the third one, the Vanguard Value Index Institutional, VIVIX, currently 0, plus that up to 9.25, and that's going to come out of
What's in the red?
what's in the red.
Yes. So no, it's not a one, there's unfortunately never quite a one-to-one, because we're not just going to manager, but we also have to think about the growth, the mid-cap, and mitigating those.
And that's why they're round numbers, I might add.
Yes,
Right.
yes. Thank you for bailing me
Right,
out.
It
CFO?
looks good to me. And they all equal 0 at the end of the day, right?
Yes, most important thing,
I don't have
unless,
my calculator here. It looks-
yeah, no, well, you can see that up at the top, the rebalancing
Yes.
column. If it didn't come to 0, then that wouldn't be 0. Yes, but it is an identity. Thank you for bailing me out there, Dr. Bridget, I appreciate it.
Well, these are new formatting for us. It's in a new format, it's a new chart, and so it's helpful to
I like
walk
this.
through it.
Yeah.
And I like it as well, and I think we'll get used to it at each
Yeah.
meeting, that these are easy to follow once we're familiar with the new format. Thank you.
And I appreciate that. Not to get too off track here, but you make a great point, Dr. Bridget. I recognize that this is a new relationship, and you've been used to seeing things very differently in the past. So any feedback, positive, well, we all love positive feedback, but constructive and negative, that's what we want to hear, because like I said, we have precious time. I want to make sure it's an efficient use of everybody's time. So to the extent you want to see X, Y, Z, please let me know.
Sure.
Thank you, appreciate it.
So I will commend you for your overall presentation. I just got to get up here. And for the transparency with regard to the questions you've been asked, not just by me, but by others.
Thank you. Any other questions or comments on the rebalancing proposal, in particular on page 25, by any of the board members?
Move we accept that as a recommendation.
Thank you. I have a motion on the floor. Is there a second?
I second.
We have a motion and a second. Any discussion? Hearing none. All those in favor?
Aye.
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 Any opposed? Motion carries. Thank you very much, and we do appreciate it.
The only other action, if I may.
Sure.
Dr. Bridget, if you can skip ahead to page 30, to circle back on our earlier comments, the board did approve the rebalancing, and thank you. But I do think we need, since it's not just a straight share class conversion, if you look on the top of page 30, a recommendation for the board to approve a full liquidation of that Black Creek Diversified Property Fund, the S share class. So just to reiterate, we cannot do a straight share class conversion. The only way we can get rid of that 85 basis point fee is to do a full liquidation and subsequent purchase of the I share class. And as you note there, in an amount approximately equal to the liquidation. And why I say that is because we're not going to know what the amount is, because it's valued on a monthly basis until we get the check.
Yeah.
I'm using we loosely there, so.
So my comfort level relates to my earlier question about returns. And so for me, before I liquidate the whole fund, I'd like to have a little bit more detail so that I understand more comprehensively what the impact is. I understand the fee and the classification change, and I don't know how other members of the board feel about that.
It would be nice to see the return and see where the amount is. Do you have that info, or?
And I was just, for me, and I appreciate that, if you don't have it today,
Right.
how urgent is this decision? Could we put it on for the next agenda? Or do you feel like this is more urgent that we should take action today?
So a couple things, Dr. Bridget. Number one, if the board approved it today, Catherine has the document ready to go to be submitted. It needs to go today. To your second question, so what we're talking about here is just being out of that market for a month.
Right.
Okay, so the fund has an annual distribution somewhere in the neighborhood of 4%. So quick math, 12 divided by 4, about 35 basis points a month.
Yeah.
CFO, right? Okay. 35 basis points a month, which would be, again, reducted by that 85, which is about 7 basis points a month. So it would be foregoing a 0.28% return on a $1 million investment. So you would be foregoing that, foregoing about 0.28% on $1 million, which is $2,800. Am I doing that? I believe I'm doing that correctly. And then, I know, it's a public meeting, I know, about $2,800 on a $160 million portfolio. So that's the background I have to help you consider that. And again, we can do the liquidation and then the subsequent purchase. So we're only out for a month. On 3-1, we're back in at the lower share clause, at the cheaper share clause.
Great, thank you.
A bigger question for me is, do we want to stay with them?
Right.
What are their diversified properties?
It's a private REIT, so when you think about the real estate market from an institutional perspective, many counties' clients are more invested in, say, core real estate, things like that. So major urban markets, office, retail, industrial, multifamily, in markets like Los Angeles, San Francisco, New York, Boston, you get the idea. So those are more institutional quality type funds. This fund would be broadly in those same sectors, office, retail, industrial, multifamily. However, they're not Class A properties, so they're not skyscrapers in New York and Boston and this and that. They're, more strip type malls, more maybe manufactured housing in more niche or tertiary markets like a Richmond, like areas like that, which we all well know, but don't necessarily. They're not primary markets within real estate. So I'm sorry to circle back, Mr. Walters, is that I think it would be prudent for us to tackle this sequentially because the money has to go somewhere, and take a hard look at all the alternatives, which we plan to do anyway. So that would be my recommendation. Yes,
Has
sir.
this got a lock on it time-wise?
It does not. I did confirm that. I asked the gentleman, Bo, who we dealt with, I said, hey, if we did the liquidation and the subsequent purchase, is there any lockup? And he said no.
And so Sergeant Moses, do you have any thoughts on this issue, comments or questions?
I do not. I'm good. Thank you.
Okay, Sergeant Safford, same thing. Any comments, questions on this issue?
No comments or questions. Thanks.
Okay, great. So then it's really entertainment for the board if you'd like to have the motion on page 30 to recommend the liquidation, or if you'd like to postpone. So whatever is the pleasure of the board.
Well, with regard to the Black Creek Diversified Property Fund S share class, My recommendation is that we defer, and in the meantime, I would kind of like to see whatever you've got on what they hold and where it is. I mean, you can go out here on your drive home, get off the interstate, and there's an awful lot of vacant storefronts right now,
Yes, sir.
and anchor stores right now. We may not want to be in these.
So do you feel comfortable that's a motion to defer?
Motion to defer, that is correct.
Thank you. Is there a second?
I'll second.
Any discussion? Hearing none, all in favor?
Aye.
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 Any opposed? Motion carries. Thank you very much. Appreciate it. Anything else for us today?
No, thank you, but I appreciate your time and look forward
Do
to
we
seeing you
need-
shortly.
We did vote on that other one, the bottom.
We did.
Yes, we did that one first. We were out of order, but we got them done. Great, thank you very much. And I know it was a very thorough, comprehensive review for us today on both of your presentations, so we appreciate it.
Doctor, do we
You're
need to skim code any of this on 32, rather?
Let's see, on page 32, Mr. Walters is asking if there's anything to review for us for next steps, and I'll turn that back over to you, Pat.
I'm sorry, I apologize.
That's okay. We did our...
We spoke many of these things already, so just to shift gears. So at the next meeting, we'll have the quarterly performance report again. That will be prepared by Morgan Stanley, so we'll present the report going forward. It'll be our reporting once we get the data. We're going to do the fixed income structure review, largely like we did equities today. That will be much more abbreviated, as I'm sure you're happy to hear. Because there's only a few managers and the analysis will be more abbreviated, but that's the next step we want to take. And then shift gears to subsequent meetings. We'll continue to update the board on the transition and the fees paid to alternatives like we discussed earlier. We have that asset allocation, particularly around alternatives, the sizing, the composition, liquidity concerns, how that'll feed into the investment policy. Again, like we said, we're talking with custodians, seeing what's available in the marketplace and what, if anything, the board should consider, and then traditional versus OCIO. So I think the only main change, unless the board has other comments, is that I will follow up on allocations, not just to Black Creek. I will follow up with allocations on the other private REITs. Remember, the one's liquidating, but the other two we have the share class. And if the board would rather move forward with a change there, not only would I give you that information pre-next meeting, but I could come back if you could maybe share some feedback with Catherine or Karen, who I talk to regularly, about whether you would like to consider some alternative option. Happy to do that then. So that would be my only change based off what's here, unless there's other direction the board would like to provide.
That sounds good.
No, it does.
Sounds
Thank you.
good. Great. Thank you. And thank you for the review. Whoops. Next on our agenda is committee reports. Karen Gates has the administrator's report. Ms. Gates?
Okay, we had 2 invoices, one from Fiduciary Plan Consultants, and I believe this was the final invoice. That invoice was $10,000, but it was split between the trusts, LoSAP, SORP, OPEB. That invoice was for $5,136. That was the share for SORP. And then Bolton Partners, or Bolton Retirement, calculated a lump sum distribution, and that charge for that was $151. The total paid was $5,287.
Great. Thank you very much. Any questions or comments on the plan administrator's report?
I move to accept as presented.
We have a motion to accept. Is there a second?
Second.
Any discussion?
I'll-
All those in favor?
Aye.
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 And Sergeant Moses, did you vote on that one? Did we lose Sergeant Moses on the phone?
No, I'm Dr. Bridget.
Okay. Are you affirmative on the vote?
I am, yes. I'm sorry.
Thank you very much. Hearing no opposition, the vote carries. Do we have any public comments, Karen? Okay, no public comments, then we'll entertain a motion to adjourn.
I move we adjourn.
Is there a second?
I'll second.
All those in favor?
Aye.
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 Any opposed? Motion carries. Thank you all very much. Appreciate it. Have a nice rest of your day.
Thank you.